So one of the most important parts of investing, one of the most important parts of investment planning is your investment allocation, your asset allocation, where your money is. And there's a lot of these studies, we'll have to find one, but there's a lot of these studies that reference that your investment allocation is going to be responsible for more than 90% of your portfolio performance. So having the right allocation to the right investments is really key. And the basis of that is sort of a pie chart. So you should be able to look at your investment plan and have somewhere, either on one statement or a custom statement that's created from all of the different investments that you have, whether it's private keys or at a conventional investment firm. You should be able to have something that says your total amount, and you should have a pie chart that shows what percentage is in what. Okay, and then what those things are. Maybe you have some real estate and some stocks. And then within that, those might be categorized further. So it could be large cap stocks, and then this might be small cap stocks, and so on. And the goal is to have an investment allocation that is diversified, and diversity in an investment portfolio will lower your risk over time. Because what happens is this: if you have one asset, suppose you have large cap growth, this is how pretty much all growth assets tend to go like this. They go up and down over time. That's how stocks grow. That's how Bitcoin has grown. That's how other growth assets, even real estate, gold, everything tends, and there's different planes. Not everything will go up, obviously. Some things will just go down and stay down forever. But in general, growth assets that are good assets over time grow, some smaller, some slower than others. Something that's denominated in cash and is a fixed cash return, like a CD or a treasury bill or a money market account, in that currency that it's denominated in will just be very, very flat. But compared to something else, it may look like it's falling or rising depending on that other asset. So having an asset allocation that accounts for all of this is really key, because if you have another investment, it may perform slightly differently, might go up and down at different times. And when you combine them together, the goal is to reduce that volatility. Reducing volatility is very key, because if you have $100,000 and it goes up and then it goes way down to, say, $80,000 and stays down for a little while and then goes up, you can do an analysis that will show that you're actually making less money because of this volatility, because of these down points. Ideally, you'd want something that's just very flat and keeps going up. You don't really want volatility. An amateur mistake, a lot of people say, well, I can afford a lot of risk. I want risky investments. Well, of course you don't want risky investments. Typically, the higher returning investments have been risky, but you don't really want risk. You want as smooth of a line as possible that's in line with your objectives. So that's what an asset allocation will do, and that's a really, really key part of your investment plan. It's something that we can help you with through some of the free software and some of the other tools that we're working on to be able to help people think about where your money should be. Now, as far as crypto goes, it's really important to remember that you shouldn't have all your eggs in one basket. Even if you believe that something is going to do well, something like crypto is a very speculative asset category, and you don't know if you're going to be right. And sort of tribes and certainty are the enemy of good investing. Somebody who is certain that they're right is usually not a great investor, because you can have all the reasons in the world, and I can tell you the reasons just as well as anyone. Bitcoin, for example, why it makes sense, why it's better money, meets the properties of money better. But the world may disagree. There's all kinds of things where the best product doesn't work. The Tucker automobile, the Betamax video cassette, all of these other things. It doesn't always work that way. So you can't predict. The world is too complex. You can't predict what events may happen, what global war there might be, or anything like that. Any number of different events could affect your long term. But a good asset allocation plan hopefully can help mitigate that a little bit.